Hello, I'm Russell Minen, and on this video we're going to talk about a smarter way to self-insure long-term care expenses. Let me ask you a question. Do you own insurance on your home? Do you have insurance on your cars? Do you have insurance on your life, on your health? Well, probably you'd answer yes to some or all of those. Well, why? Why do you have insurance? Well, the basic concept of insurance is to transfer that risk of financial loss from yourself to the insurance company. So if your home burns down, you don't want to have to spend $100, $200, $300, $400,000 to replace it, but you'd pay maybe $800 to $1,000 of premiums to the insurance company, so you transfer that risk. Well, what's the problem today with long-term care? Well, 70% of the people age 65 or over need some form of long-term care in their life, either nursing home, home health care, assisted living, adult daycare, some form of long-term care. Well, the cost of long-term care, at least here in Texas where we're at right now, it's close to $50,000 per year for a semi-private room in a nursing home. So that's expensive. Just about 10 years ago it was about $36,000. So those costs are going up significantly every year. Well, the other problem is most people, the majority of people over age 65, do not own traditional long-term care insurance. Yet they insure their homes and their cars and their health and their life. But I would ask them, well, why? I ask people, why don't you have long-term care insurance? Well, most of them say right away it's the cost, which means they've already looked at the price. And the older you are, the more it's going to cost. Surprise, that's when you're likely to need long-term care. So, and some people say, well, I don't want to get it because we don't ever need it, then I just wasted all those premiums. Well, true, but that's true with any kind of insurance. And most men would probably say, either spoken or unspoken, well, if I have severe health problems, well, my wife's just going to take care of me. And that's what usually happens. But that providing care is a 24/7 job. It is extremely stressful. The physical needs or physical demands on a person who's providing the care, say it's a wife who may weigh 110 pounds and her husband may weigh 250 pounds, it really gets difficult. So that'll happen, or the wife will take care of husband for a while, but after a while something has to happen. So what I tell people is that that's okay. I'm not here to convince you to buy traditional long-term care insurance, but in effect what you're doing is self-insuring, and that's okay. Your self-insuring means you're accepting that financial risk, either unspoken or spoken. You are self-insuring. What I'd like to do, and what I tell people, let me just show you a smarter way to self-insure than what you're doing now. Now, I've got a chart with some numbers on it. I'm going to flip that page over, and we're going to focus on this and just see if this is a pretty cool way to, or better way to self-insure. Let me flip this over. Make sure I get the right page. There we go. At the top you'll see a smarter way to self-insure LTC, which stands for long-term care. Here, let's focus on the left side here first. Maybe you have money now in a bank or a money market account, and let's say it's $100,000. That's just round numbers. It could be $50,000, $25,000, or maybe it's $500,000, whatever you have. Say you have some liquid money. Most everyone does, especially women. They've got some money set aside. Well, if you need long-term care, that $100,000 would probably be used. Your family's going to have to use that for your care. And whether you think about that or not, that's what's going to happen. Well, if you then don't ever need long-term care and then you pass away, that money, that $100,000 plus a little interest, whatever it's been earning, will pass on to your heirs or to your beneficiaries. So this is for a female age 65. Let's just say you move that $100,000 over to another account over here. The same $100,000, you move it to an insurance company, and that money in that account is earning 4% interest, which it is. But if you need long-term care, that $100,000 now becomes $450,000 for long-term care. That money has been increased by 4.5 times for long-term care. Whereas if you left it where it was in the bank or money market account or even in your stock account, that $100,000 is all that's available for long-term care. You've leveraged your money 4.5 times by this type of product. This is a financial product that increases the amount of money for long-term care. The amount it increases by depends on if you're male or female or smoker or non-smoker or what your age is. So this is for a female age 65, by the way. If you're older, it's a little bit less. If you're younger, it's a little bit more. So you've gone from $100,000 to $450,000 available to you for long-term care expenses for nursing home, assisted living, home health care, or adult daycare. Well, what if you never need long-term care? What passes on to your beneficiaries or to your heirs? That's the $100,000. If you don't ever need long-term care, it turns into $150,000. As opposed to if you left it where it was, it'd be $100,000 plus whatever interest or earnings. And by the way, this $150,000 at your death is paid tax-free to your beneficiaries. And oh, by the way, this money you use for long-term care comes out of this account tax-free, all according to current tax law. So you have tax-free long-term care benefits, that's 4.5 times the amount in your account. You have a death benefit, that's $150,000 instead of $100,000, tax-free. Well, what about if you just quit? If you decide to get all your money out of either your account at the bank or the money market account, you would get that money plus whatever interest, the $100,000 plus interest. In this account, in this insurance account, if you quit, this account has a 100% money-back guarantee at all times. So if you got out of this account for some reason, no matter when, after 6 days, 6 months, 6 years, you get back at least what you put in, maybe a little longer. Now really, people don't tend to want their money back because this is their form of long-term care insurance. And this is a great way a smarter way to self-insure these long-term care if you have some money and if this money is not currently being used to supplement your income. Now, this type of plan is not available for everyone. Not everyone is eligible. You have to, there's a series of health questions. You have to be able to answer no, that you don't have any of these health conditions, and that will allow you to apply for the coverage, and about 80% of the people who apply are approved. There are no exams, by the way. We just got word today that one lady who applied, who did put $100,000 in, that she was approved as of today. So if you can answer no to all these health conditions and would like to apply, you have a great chance of being approved. So this is a much smarter way, better way to self-insure those long-term care expenses. Hope this has been helpful. Thanks for watching. Be sure to watch future videos. Thanks.